So I got the data going back to 1980 for world oil production and world oil consumption. And I tried. I looked hard, I studied the data as close as I could, and I could not come up with a supply-demand explanation for why oil was flying all over the place during this period. In fact, let's just look at B to C. You can see production rose and consumption rose. And during that time, we had a very large rise, 300% plus, in the price of oil. But from C to D, we had an even larger increase in production and consumption, and the price dropped 76%. So there just is no relationship that you can hang your hat on here.
The supply-demand model did indeed fail to predict the many large turns in the oil market since 1998. Yet in this 29-minute presentation, you can see and hear for yourself how 5 different analysts across those years all used a better forecasting model to anticipate crude oil's biggest moves. Their forecasts were not based on crude oil's supply or demand. So let's rejoin Bob Prechter's recent presentation to the Social Mood Conference in Atlanta, Georgia, as he shows what does and does not drive oil prices.
So let's ask another question. Rather than supply and demand regulating the price of oil, maybe it's something completely different, something that R. and Elliott called the wave principle. Now, the wave principle is a model of a hierarchical fractal that Elliott described empirically back in 1938. He said that bull markets occur in 5 waves, and the components of the moves in the same direction also occur in 5 waves. So the components are structural parts of the whole. Just as a branch looks like the whole tree if you set it upright, you've got the same thing going on in smaller and smaller and larger degree waves. It turns out that the oil market has been tracking this Elliott wave model with very, very close accuracy since the low in oil prices in 1910. Now, it'd be one thing if I just put labels up there on the oil chart and said, okay, it follows the Elliott wave model. Well, you know, anybody can put labels on a chart. Maybe he just made the chart fit. So I'm going to treat you to something much better than that. But as a setup, you see the little arrow there? That is when my company, Elliott Wave International, went into the business of advising institutional level people. So we got specialists in all the different major areas of the market. You know, currencies, commodities, stocks, interest rates, and energy. So we began to forecast the oil market in our monthly publication, Global Market Perspective. And based on the previous waves, and I'm going to show you a long-term chart of actual prices in a moment, that arrow is where we believe we were in the overall pattern going back all the way to 1910. And that is the model we work from. Now, what you're going to see as we go along here is 5 different analysts from Elliott Wave International using the same model and picking up where the other one left off. If it were all the same person, somebody might say, oh, well, that was just one lucky person, happened to be, you know, in sync for a period of time. This is 5 different people kind of replacing each other in rotation using the same model. Now, if you were just to look at oil prices historically, and this goes all the way back to the discovery of oil in 1859. So you see, we've got those prices up there. Most people would look at that and they'd be lost. They wouldn't see a pattern. They just see the prices kind of going down and bouncing around and then going up and then bouncing around again. With the Elliott wave model, we try to make sense out of those wiggles. So here's how we look at it. A long corrective process into 1910, and then a first wave of a great bull market, a wave 2 decline. Wave 3 is usually the longest in what Elliott called an extension. It subdivides into another clear 5 waves. We had that going into the high of 1980. And then we've had this sideways period where you get a rally back to the previous high in the middle of it. That's that Roman numeral 4 period. But as you can see, we hadn't gone down to the lower channel line. And many Elliott wave structures fit within these quasi-geometrical forms. And we felt that that would do that. So our first publication, the first year that we started publishing Global Market Perspective and having a special section on energy and especially focusing on oil, was 1993. So our analyst looked at this picture and he said, the bear market's not over yet. We don't think it's quite over yet, so be patient. And our first analyst at that time was named Peter DeSario. And in the December 1993 issue, he said, quote, price should fall into the general area of $10, that's $10 a barrel, parentheses, to end a fourth wave move from 1980. So you can see that we're adhering to this model. We said wave 3 in that previous diagram had peaked at the top in 1980 after that long extended third wave. We've been in a fourth wave ever since. It's very volatile. Prices are bouncing up and around. That's very classic for a fourth wave. But notice most people when they forecast the market just say, well, I'm bullish or I'm bearish. I think it's going to go up or I think it's going to go down. This is a two-step forecast. We're going down to $10 and then new historical highs. That's a pretty good perspective right there. All right. So oil prices meandered around for another 5 years until they finally came down in December 1998 and hit $10.35 a barrel. So what was our publication saying? Were we bearish along with everybody else? Because you already know, if you're market people, that we would have had 95% bears at that point. In other words, they would think oil was going lower. That's what every low reports. Well, at this point, another analyst had taken over. 5 years had gone by, so at this point, Al Graham was our energy analyst. And this is what he published on December the 4th, 1998, right into that low. See that little comment in the center near the bottom? Must hold 975 support. In other words, he said, this is a flat correction. It's not going to break 975. Sure enough, the low is $10.35. And then, now look at the multi-step forecast he's making. We've got a bottom. We're going to rally up, but not to a new high. And then the market's going to pull back, not to a new low, and then it's going to take off to new all-time highs. That's a three-step forecast. And this is where we were on December the 4th, 2000. The market did take off, and it tripled, more than tripled. That's a hell of a call in and of itself. It didn't make a new high, didn't make a new all-time high. The old high was 40. And Peter Raymer was then our editor. Now we're on to our third guy using the same model. And you can see what his quote is at the bottom. We are soon likely to see a wave C of 2, this is jargon, I hope you'll put up with that, decline, where oil tests the 50% retracement to the 1913 level. So what he's doing is he's bearish here. He's telling you it's going to go drop in half. That's a very dramatic move for any market. And then go to new all-time highs. So he's following the previous guy's outlook, and this time he says, okay, we're there now, we're at the top of 1. It's actually B of 2 because we had a flat correction working. And then his last line, once the correction into 1998 was over, that was that low at $10.35, crude exploded upward, and I expect the same outcome. So again, a multi-step forecast. We're going to drop in half, go down to just about $19 a barrel, and then take off to these new highs we've been telling you are ahead. And that's what happened next. It went a little bit lower. You can see with the arrow where he had forecasted 19. It actually fell slightly below 17. Not a big difference on this long-term chart. So he got his setback. Now the second part of his forecast was oil is now going to go to a new all-time high. Well, after several years, oil had climbed to a new all-time high. This kind of puts it in a little bit perspective. We've got that 1980 peak where we put the Roman numeral 3, that's a very large degree, and then the Roman 4 in 1998, nearly 20 years later, and now we're into this big fifth wave bull market. We've had waves 1 and 2, and we were in the middle of wave 3. Now normally I wouldn't show you one where we're in the middle of a wave. We try to get near to the end when we can, but I had just been invited to speak in Vienna, Austria, at a special conference about oil. Now, do you think they hold special conferences on oil at $10 a barrel when it's a great buy? No, of course not. They wait till it's gone up 6 times in value, and then they hold conferences. So this is the chart I brought with me in March of that year. And I said, look, we're at new all-time highs, but primary 3, the one with the circle, that wave isn't quite over yet. We're going to fool around for a little bit, pop to a new high, and that should do it. And then we'll have another drop, that's the circle 4, if we're fitting within our 5-wave fractal form, and it's going to be kind of a cousin of the circle 2. It's going to be of that degree. And then we'll get the final move up. So that's where we are in the whole picture. Well, just a few months later, we ground our way into a peak of that circle wave 3. And this is the chart that I published in the Elliott Wave Theorist, July 25th, 2006. I think it was a week and a half after that peak. Now, one of the things that scientists like to see about a theory is, does it predict? Now, as we go forward here, we're going to be kind of going back and forth from the Elliott wave predictors to the supply-demand predictors. And you're going to see a stark difference between the two. Anyway, sure enough, that was the high. But as we were coming into the peak, as you know, this is when people really get excited, particularly as from our Elliott wave analysis. People love it near the top of wave 3, and they love it even more at the top of wave 5. And all of our sentiment indicators reflect that. Oil dropped sharply from that point. Now we're in January 2007. Okay, this is the 5th analyst involved, okay? And we're still following the same model. We're expecting wave 4, and he was doing the analysis. He's still our energy analyst, by the way, Stephen Craig. And at this point, he said the 3-wave structure, remember, counter-trend moves are always 3 waves, moves in the direction of the larger trend are 5. This gives you a natural, not only a natural fluctuation, but a natural trending. And that's what Elliott saw empirically, and we think that's happening in real life, and it's useful for forecasting. So the 3-wave structure from the top fits my outlook for a corrective decline. And what does he mean by corrective? He means it's going to only be a partial retracement. It's not going to crash. We've got more upside to go. I've adjusted the count to show the decline as, here's more jargon, wave A of primary 4, a strong B wave advance would be the norm. Given the depth of the decline, however, a 38% retracement of wave 3, a strong alternate interpretation is that wave 4 is complete. As it turned out, wave 4 was complete. Notice that both of his outlooks called for rising prices, a rise in B or a rise in 5. Turns out we took off from that point. Wave 4 was over 38% retracement was the perfect amount to end that decline. Okay, so that was at the circle 4. You see that down around, I think it was 49.90 per barrel at that low. I mean, look at that, beautiful, just blast off. It's also completely normal. It's in the book we wrote way back in 1978. 5th waves in commodities tend to blast through the upper end of the channel and get into a blow-off phase. Now, most of the supply-demand people watching the market at this time were bullish out of their minds, and they had all kinds of supply and demand arguments for why oil was going to go to the moon and would never come down. We don't forecast linearly. We forecast with a fractal model, so we are looking for turns when the subdivisions have completed. To me, this was really clear, thanks to the Elliott wave model. So that was my headline, spike top doing crude oil in the $160 to $189 range. And in the text I wrote, one of the greatest commodity tops of all time is due very soon. That's a pretty bold call in the middle of a freight train going straight up when the world is running out of oil. But only the Elliott wave model can allow you to do that. Well, what were the supply-demand people saying at this time? Now, if they had good models, and their models were good at forecasting, they would be telling you why, supply is about to overwhelm demand, or demand is about to shrink, and the market's going to reverse. They weren't saying anything like that. I could show you a dozen articles or 24 articles that detail the supply and demand arguments at that time for higher prices. But this one was a really good representative one, so this is the one I brought. And my little headline up there, I say, supply-demand theorists not only failed to envision the possibility of a major peak in prices in the summer of 2008, but also fully embraced the upward trend right at the top. Now, why do supply and demand theorists embrace the trend at the perfectly wrong time and again? They do it because their model doesn't work, and this puts them into a context of uncertainty. In a context of uncertainty, people start ignoring their cortexes, and they start going with the lower brain back here, which is screaming at them, follow the herd. That's how you'll survive. And they are following the herd, but they're doing it with an intellectual veneer, and this is a good example. This is from USA Today on the 1st of July. I think this was like 6 days before the all-time high. Quote, efficient market purists cite Economics 101, there we are again, everything's obvious, concept of supply and demand as the main reason a barrel of oil has surged above $140, up nearly 50% in 2008. The senior market analyst at sums up this thesis best. Quote, you can argue that the economic fundamentals for oil are as strong as they have ever been in mankind's history. No, let's find out what happened. Okay, this is a battle between Elliott waves and the supply and demand theorists. It missed my target. I thought it would get at least 160. It topped at 147.50. But I think that is the biggest commodity drop of all time in only 5 months, 78%. Now, do you think anybody saw any change in supply and demand during that period? You know, nothing you could really write home about. Now, obviously, this is occurring during the Great Recession, which had started. It didn't cause it, though, because it had started 7 months before this peak. In fact, it was running up all during the first 7 months of the Great Recession and bottomed 6 months before the Great Recession ended in June 2009. So it's doing its own thing, all right? So notice that label at the bottom, A. If you remember the first graphic I showed you, we needed to finish the 5 waves of the Great Bull Market first, and that we did. That's that Roman 5 up there, following our model all the way. But now the bear market period is going to be in 3 steps. Down first, up again, not to a new high, and then down to a lower low. That's our model. And we're sticking with this model. We're putting an A there. That says it's not over. Well, it's over short term because we put a label on there. So we're going to rally for a while, and then the market's going to come down to a lower low. That's incredible perspective from this model. Again, it's going to be a 2-step forecast. We're going to rally a long way and then fall. Here it is, January 16, 2009. Oil is back down testing its lows. But here's what the supply-demand people are telling their followers. Quote, world oil demand will contract sharply in 2009 as the global economic slowdown, which they didn't anticipate, further erodes consumption. That's the demand side. The International Energy Agency said on Friday. The Paris-based agency joined the ranks of forecasters predicting a fall in global oil demand this year. Well, what's the implication? The implication is oil's going to keep going down. Well, obviously, if demand's going to fall all year, oil's going to go down all year. And here's what we said just a few days later after reading these kinds of things over and over in the newspaper. Actually, economists have no reliable basis even for predicting further slackening in oil demand. I mean, forget predicting the price. They can't even predict slackening oil demand. Maybe the recession ended yesterday. What's more, even if demand for oil were to slacken further, prices may already have bottomed. So that was our little A. Turns out that was the low. And you might think, remember I showed you that straight down crash? I said, well, you can hardly see Elliott waves in there. Well, expand it out to a daily chart. This one is on log scale, and you'll see a very nice 5-wave subdivision, which is what we should see under our fractal model. The actual price in January was slightly higher than the one in December. We call it a truncation, but it still fulfilled all of the requirements of an Elliott wave decline. Okay, now I was invited in early 2011 to submit an article to Market Technician, which is the journal of the UK's Society of Technical Analysts. And I had gone there to speak about oil, so I followed up with this article about it. And I updated our picture. We labeled the early 2009 low near $33 as wave A, a large ABC corrective pattern. That's A down, B up, C down. Oil has since more than tripled to 107. I mean, you know, if you just were right on one of these calls, you could do very well. And should be near the peak of wave B. And that's what I put in italics there. So you can see, okay, we're making another market call. We should be very near the peak of wave B. Though the Federal Reserve has all but guaranteed that it will create inflation, this is when they were going QE crazy, this wave labeling implies that the dollar price of oil I wasn't saying, the real price. I'm saying the dollar price, despite this massive Fed inflation, will fall below the 2009 low sometime this decade. A few weeks later, in May of 2011, we actually said, okay, we think we just saw the top of B. The top chart was kind of easier to decipher. This is the overall CRB commodity index. Beautiful trend channel, peaking right up near the top, 62% retracement. It was a beautiful picture. Oil fit into it. In fact, it's a big component of the CRB index. Wasn't quite as pretty, but it's certainly a clear three-wave subdivision, and that's what we look for in a counter-trend move. So we're saying, okay, B is over. Now we're going to come down. What were the supply-demand people saying at the time? Well, oil didn't go straight down. It held up for quite a long time, near $100 a barrel. It was holding up in 2012, holding up in 2013, and holding up as we got into 2014. And during this period, here's what the supply-demand people were telling you. Investors are snapping up oil contracts in case fighting breaks out in the heart of one of the world's biggest oil-producing regions. Everyone's pricing in the potential for war now. What does that mean? Well, they think supply is going to be cut, and that'll push prices up. They're still in mechanical mode. Without a concrete resolution, nobody knows how high this can go. Now, you could just easily as write, without a concrete resolution, nobody knows how low this could go. But of course, at a high, everyone's optimistic. That's what's keeping it up at the price highs. It looks like they'll keep climbing. So the default is, we're not sure why. We're all part of the herd, but we think it's going up. So they're rationalizing the reasons. Time magazine says, in the long term, global demand for oil will increase. That's hilarious. Do you remember the chart I showed you of consumption and production? The two lines, they've been going up, up, up forever. I mean, the world, population's bigger, we're using more oil. Well, of course, global demand's going to increase. But, they didn't talk about the supply side. What about the supply? They didn't talk about that. Driven by developing countries, I always love those little nuances, which means that someday soon, $4 gas is going to look cheap. The next headline is a great one. Oil prices at $200 a barrel, something is coming. Okay, signs that crude futures may hit much higher levels are converging. So now the supply and demand isn't just like I see one thing or two things. I see 10, I see 12, they're all converging. Some of whom predict that Brent crude could reach $200 a barrel within the next 12 months. The biggest issue, they say, is that global crude supply remains uncommonly tight. So they're always talking about supply and demand, and this is supposed to help them predict. Now, one of my favorites here is energy experts say gas could hit $8, that's $8 a gallon, if Iran closes the strait. And what's funny about that is Iran actually threatened to close the strait several months later, and on that very day, oil dropped $3 a barrel. So all their reasons don't work. In fact, they're exquisitely, they torture them, because when they do happen, they lose money. They don't get what they want. And then gasoline prices are about to pinch. Now, this is the second to last one down there. This is they're quoting a widely quoted economist. He's the head of a think tank. And so he's got a demand comment. He says, once the air conditioner comes on, there will be no relief for the pocketbook. So he's saying, well, demand's going to go up in the summer because the air conditioner comes on. But of course, in the winter, the heat goes on, right? So, we're always using oil. That's what the supply-demand people were saying in 2011, 2012. You notice these are just from a few months in 2012. I kind of picked them out randomly. They were just flying out. Every third or fourth day, there was another article on supply and demand and why gasoline and oil were going to the moon. And you also saw the same types of comments, not just about crude oil, but about gasoline. You see the one kind of in the middle there, higher gas prices here to stay? That headline appeared in the Toronto Star on July the 12th. The all-time high in crude oil, and gasoline for that matter, occurred on July 11th. So somebody was up that night writing that headline, which appeared the next morning in the paper. So on the exact high day that article appeared, high gas prices are here to stay. It was the absolute top tick. Okay, so then you had the A-wave crash, right? And gasoline was a little bit stronger, wasn't quite as precise as oil in reflecting this, but it still didn't make any new highs during the whole period. And look at those wonderful headlines throughout 2011, 2012, 2013, 2014. Oil's holding still near $100 a barrel, but it's not making new highs. It never went above that May 2011 peak. Now I'm going to give you a little bit more perspective. There's a big part of that bull market. Now we had the A wave crash. We labeled B already. We said that's over. And these were subdivisions of the next bear market, in our opinion. And we got nearly apoplectic here in March, April, and May of 2014. And we decided, look, we've got to comment because so many people are telling us it's going to the moon, there's no end in sight, it's going to go new all-time highs. And we pointed out something in the sentiment area, very, very important. On the 31st of March, 91% of futures traders who trade crude oil futures were bullish on crude oil. That's a big percentage. An all-time record net long position had just been recorded among large speculators. A lot of people think large speculators are smarter than the small speculators, but they heard just as much. And there's an all-time record short position among the commercials. I've tracked, I think, 16 groups that you can identify as market participants, mutual fund managers, hedge fund managers, economists, and so on. All of them hurt. They all get more bullish as the market goes up and more bearish as the market goes down. But there's only one group, except for some studies showing technicians tend to be non-herders at times. But the one group that's consistently a non-herder is the commercials. Now, I think we have a socioeconomic explanation for that. The commercials are people who are buying something, whether it be grains or oil or some other commodity, for their firm's use. So they're approaching the market not as a speculative market, not as I'm going to try and buy to make money. They're approaching it as an economic market, the way you and I go into the hardware store. We just say, well, I want to buy, a hammer and some nails and some wood, and I want to bargain. And if I don't get it here, I'm going to go to another store. And when things are too expensive, I'm not going to buy those things. They tend to be more right than wrong. So they had an all-time record short position at this time, the smart guys. So we put this little headline up there, deadly combination. And we meant it. And we said, you're all looking for up, and that ain't the way it's going to resolve. So here's what happened next. So it traps them every time. At the bottom, remember at the A bottom, they say, oh, demand's going to completely slacken all through 2009. It takes off in triples instantly right in front of them. All right, so this updates the wave structure, in our opinion, through just a few weeks ago. We figured that was probably the bottom of wave 3 within C. So the whole bear market is not done yet, according to our model. So here we're back to supply and demand. This was just a few months ago. On October 13th, 2015, the chief economist of British Petroleum echoed the new consensus. Remember, the old consensus was we're running out of oil, we'll never have it again. When he told a conference of economists in London, quote, it is increasingly unlikely that the world's reserves of oil will ever be exhausted. So this is how supply and demand and fundamentals fit in. Once the third wave is done in any bull market or bear market, they finally kind of see the light and they change their minds. But of course, it's way too late to profit from it. So Elliott wave analysis forecasted and or recognized in real time all of these waves and their turning points. And different people were involved, but we were plugging in the same model time and again. So does supply and demand regulate this, or do Elliott waves regulate it? I think the latter. Supply and demand is not pushing oil around. The price of oil is not determined primarily by storage capacity, air conditioning use, heating oil use, production from Russia, demand from China, OPEC's strategies, the average mileage of automobiles, hurricanes damaging offshore drilling platforms, war fears, monetary policies, protesters blocking pipelines, the extent of new oil discoveries, or shifts in production and consumption. What's regulating the price of oil is herding speculators. They determine the price of oil, and all of these cited factors, all those things that you read in the paper until your eyes glaze over, are either results, in other words, responses to price, or incidentals. They don't mean anything in terms of the price.